Well, today I have for you the easiest, my most favorite, and the highest chance of success option strategy using SPY. Now, why I want to share this one with you is throughout the week, I've had many conversations with people looking to join my mentorship. And a concern that I'm hearing over and over again is I'm struggling with consistency. I'm not profitable. I am taking the wrong trades at the wrong time. I'm micromanaging trades. I'm watching charts and just getting too in the weeds and ultimately ending up in a position that's creating a loss. So I want to share this strategy with you because it'll get you out of that mindset. It'll get you taking a trade at the time when it's most likely to succeed. You'll have your take profit orders automatically set. So you can't micromanage it because the orders will just take like that. So let's dive in and have a look. Before we do, this is not financial advice. I'm not a financial advisor. This is not a buying recommendation. It's just simply what I like to do. Do your own research, come to your own conclusions, and don't just randomly trust strangers on the internet. Now, that said, actually, before we do dive in, if you're interested in learning more about my mentorship, the link is in the description. Check it out. Let me know if you have any questions. But for now, let's look at this strategy. So what we're using as a way of making the trade is an option spread. But the important part is when we're entering that trade. And all we need is support and resistance and the stochastic RSI. Now, we follow the trend. That's number one. We always follow the trend. Number two, we enter at the support and at the resistance. How do we find when those entries are? Well, let's have a look. I want to highlight this area here, right? Because this is where we've got our resistance. But of course, the very first time that you make resistance, you don't know it's resistance, right? That's the whole point of the very first time you make it. So how did we know that this was an entry? We coincided with the stochastic RSI and the turn downwards of the stochastic RSI you can see here. And this is how we know that, okay, maybe we're not getting through this level. So when we're getting the turn down of the stochastic RSI, when we're hitting a point where, you know what, this looks like it might be a top for now, we might have a little bit of a downward movement, that's when we're looking to enter a call credit spread. The other thing too is just paying attention to the candles, right? When we're getting these red candles, when, you know, we've got a couple day after day, that's also a sign of maybe we're going to come down. Okay, so the entry here would be on the 14th of January. We've got the turn of the stochastic. We're entering a call credit spread, and our spread would be built probably somewhere up around, it'd probably end up being around this sort of 705 mark. Okay, then what are we doing? We're waiting until we hit the bottom. So we knew that this area was possibly going to be support. We hit it. This green day confirmed it because we had huge volume here, move up. The stochastic hadn't yet turned, but I entered on this day anyway because I liked the look of that candle. This is a very strong candle. And of course, we got the move up. Then what happens? We get the rejection at the resistance level. We get the rejection. We get the big red candle. Then we get the turn of the stochastic. And again, we enter a call credit spread. So down here, what we're entering, I don't think I said it actually, is a put credit spread, which would be built around this sort of level. Okay. We hit the bottom again, we bounce. We get the rejection. We get the turn of the stochastic. We're entering a put credit spread. We hit the top. We enter our call. We hit the bottom. We enter our put. Okay, so that part is very repeatable. Let me take you into option strat, and I want to show you exactly how I build these. So firstly, let's look at the bull put spread. Now, I like to go out for usually about 2 weeks, and I try to keep it on the weekly expiries. So we're going March 6th, that's 2 weeks out. What I'm looking at as far as my strike price goes is how low can I go to get a net credit with a $10 wide spread of around $100. So this looks pretty good. 668, 658, net credit of 103. So what have we just done? What we've said is that come March 6, if SPY is above 668, we win. We keep our entire $103 and the contract will expire worthless contracts. But I don't let these go to expiry. What I'm doing instead is putting in my take profit at 50%. So my take profit would be, if I've received a net credit of 103, if I pay $50 to get out of this, then that's close enough to 50%. This is the cool thing, and why building at the right time, so building in this instance when we are bouncing off support, is really helpful. At 50%, we can see here $50 through these dates, right? We can see at what date SPY needs to be at what price to get me that profit. And all we need in the coming days is a move of 1%. So if SPY moves up by 1%, doesn't have to close there, it just needs to hit there and the contracts need to be trading at that level, then I can get out of this for my profit. And that's exactly what happens. I actually entered twice this week. I put one of them last week. Friday the 13th and Tuesday the 17th of February, I entered two different put credit spreads. Both of them got triggered out on Friday just gone at 50% profit. So I'm in these trades for only a couple of days. I didn't even know that they were closed out until I log into my account in the morning and I see, realized profit. That's fun, right? Now today or Friday, this is not the entry day. Okay, so I was showing you these purely to show you how to build them, but this is not the entry day because it's in no man's land, right? And when we're in no man's land, we don't know if we're going to get that 1% move, right? The same on the call credit spread. So a bear call spread, going out to the 6th of March, and I go as high as I can for around about a $100 credit. No, that's too low. 706, 716. That looks good. 706, 716. I also like to choose these random numbers rather than whole numbers. And the reason for that, I mean, it's a psychological thing, but whole numbers tend to be the most heavily traded. And they're that psychological, 705, that's the level that'll be defended. So if I'm either above or below that by a couple of dollars, it just helps to add an extra layer of safety should my strikes be threatened. So again, I build it 2 weeks ahead. 106 is my net credit. And if I'm looking to get out for 50% of that profit, the cool thing on the call side, I don't even need as much of a move, right? Like this thing literally needs to drop by 0.4%. And you can see that when we do hit these top levels, we get the drops. We hit the top, we get the drops. We hit the top, we get the drops, right? And if you set your take profit, that order will automatically be triggered. And the cool thing is, especially on the call credit side, is these wiki days. Wicks are great. Wicks get you out of trades that you would never even be at the computer to place the order on, right? We wick all the way down. You've entered this. You've exited this, right? And then you're just sitting on the sideline waiting for the next trade. Now, you could go ahead and place, well, essentially what we've just built out. What did we build out of? I think it was 706 and 558. So 706 and 558 and 658, sorry. No, 668, wasn't it, for our sold? So you could go ahead and you could build this now and it would look like this, technically being an iron condor. The reason why I choose to do them separately though is because they're going to hit their profit levels obviously at different times. And I like to just simply take each trade, the put and the call, separately rather than having them both on at the same time. There might be times when you do have them on at the same time for whatever reason your take profit doesn't trigger, or maybe you're letting the take profit go on longer. Sometimes I'll do more than 50% if I'm really liking the look of the move. I'll let it sit. So I'll let the put credit spread sit there, open, collecting as much of that profit as possible. And then I'll enter the call credit spread when we get to the top level, right? I recommend though, if you're struggling with consistency, just take that 50% profit. Take it and run. Treat them as separate sides rather than the full iron condor, because an iron condor, you can't be right on both sides, right? You're always wrong on one. Yes, you can win the overall trade, but the chances are we are either going to move up a bit and your put side will be in profit, or we're going to move down a bit and your call side will be in the most profit. So that's my SPY trade. It's never failed me to date, even through this bull run that we had, by following those strategies, by making sure the take profits are set, by making sure we're entering at the right times when we're getting that downward move, not as we're blowing past we don't enter just because we've hit the Bollinger Bands. Actually, that's something I want to touch on, right? So here, for example, we hit the Bollinger Band and a lot of people go, yeah, you're at the top. Like that's the signal of the top, right? But look at the stochastic RSI. It's still riding up. So we're going to continue to let this thing ride up until such time that we get the turn. And we didn't get much of a drop, right? But it would have been enough to exit in profit, right? Same here. We're hitting the top of the Bollinger Bands, but we're not placing these trades until we get the turn of the stochastic RSI. We're still riding the stochastic. We're hitting, all this way up. We're still on the upward move. But here we're not. So here we enter. Okay, so that's key, especially if you're looking to place the call credit spreads in an upwards trending market, is always make sure you're paying attention to the stochastic as opposed to just we're outside of the Bollinger Band, we have to come down. Because as you can see, we don't have to come down. Absolutely do not. And vice versa as well. In a bear market, we don't have to come back up. We hit the bottom of the Bollinger Band and we can still just continue to ride down until we get the turn back into the blue section, and then we're up, right? The turn back into the blue section and we're up. Turn back into the blue section, right? So stochastic RSI is it's my favorite way to help determine, is there still room to run in this move, or have we reached its potential? So let me know what you think of this trade. Is it something you already do? Is it something you want to try? I would love to hear from you. But this week, I will be placing these trades. I'll simply be waiting until we hit the resistance or the support, till we get the turn of the stochastic RSI, and then enter. So remember, in no man's land, it's not the entry. We wait for the entry, we get the confirmation, we set our take profits, and then we're in and out of these trades nice and quickly. So I hope you found that helpful. It is just one of the many strategies that I cover inside of the mentorship. Again, if you're interested in learning more, the link is in the description. We start again in early March. There will only be a maximum of 10 people in the group. I only like to take very small groups through the mentorship because I like to actually get to know you a bit, help you along the way, and give you some more personalized guidance based on what you need, where you're at, so that it's not just like mass education for everyone, because everyone is different. Everyone has different trading styles. Everyone has different reasons for trading, different budgets to trade with. They want different outcomes and all of that sort of stuff. And I think that it's important that you get what you need out of a mentorship rather than trying to fit you into something that you might not fit into. So, yes, that is it. Have a wonderful week trading, and I'll be back with another video very, very shortly.